Talk us through your strategy if you're watching for what the Treasuries curve does. And of course, it's interesting, this idea that potentially we get a little bit more conflict within the FOMC as well, potentially clouding the outlook when it comes to what the Fed will do this year.
I mean, maybe I'll just start out. I mean, I've been on your program a couple of months ago. Our forecast has not changed in the last 3 months. So conditions have changed, more news has come out. We've seen better prints on inflation, but our forecast still for 2023 and the expected rate cut has not changed. I think, though, reflecting on the minutes that came out today, perhaps confidence in that rate cut is, in some ways, the confidence in the rate cut is increasing, but we are worried that the Fed might tip the economy more into recession. So our baseline forecast was it would be a growth recession. Maybe there's a real recession that could occur because the determination to manage the spot inflation number, rather than looking at the fact that leading indicators are coming down, looking at the fact that actually the consumer is weakening very fast. You're seeing that in the housing market in the US. You're seeing that in the savings rate, which has plunged down to levels we last saw in 2005. So consumers are really eating into their savings very rapidly, more rapidly, I think, than certainly we had expected. So this shift can occur from being worried too much about inflation, where all the supply side pressures are loosening at a very fast rate, to really getting worried about growth because the consumer is weakening. There is still strength in the labor market, but increasingly we're saying companies are moving away from hoarding, and bulk of the gains in the labor market are occurring in actually low wages, so more with small employers, less than kind of 50 employees. That segment is where we're seeing still pretty robust demand for labor, but everywhere else we're seeing somewhat weakening occurring in that. That picture tells us perhaps the shift is going to occur where the Fed is going to start focusing more on growth at some point in time. We take the view certainly that the 10-year is very well anchored at somewhere in the, call it the 3.5 to 4 range, which we've been buyers of duration for the last few months.
Gaurav, I hear you when you say your views haven't changed, but obviously some of the positioning around the edges have been tweaked. And one of them that's interesting to me is perhaps a little less long cash because of the changes we've seen in the US dollar. Where have you reallocated that?
So it's been occurring across Europe, somewhat across Pacific, so Japan. Incrementally within EM, we have bought some in China. I would just point out and say that we're more market weight in China right now, looking for reasons to be overweight, but we just want to make sure that we get a better understanding of the situation on the ground, make sure we have a better feel for how the COVID situation is playing out. So I would say still cautious on that till we get into perhaps Q2, but certainly reduced our underweight occurring in those markets. So opportunistically buying some areas where we thought there was better opportunity than sitting just on cash.
Gaurav, you also mentioned a commodities hedge in your notes. Explain this to us.
Yeah, so I think that this is more of a hedge in case there are any adverse scenarios that play out with regards to inflation. So if inflation, which we anticipate will come down to a 3 handle by the end of 2023, if that doesn't happen, it gives you some protection in your portfolios, especially in a world where still right now, if you look at stock bond correlations, they've come down from very high positive levels to somewhat lower positive levels. And you've seen on a short-term basis some negative correlation, but still we're still not out of the woods, so to speak, right? So that seems to be a concern to us that the stock and bonds both could behave in the same way, same direction. So commodities provides a bit of a hedge as you think about those two asset classes getting more correlated as long as inflation stays a bit high.
Gaurav, how much are you buying into the China enthusiasm, both in terms of Chinese assets? We've seen very strong starts to the year when it comes to Chinese equities, albeit it's hard to kind of go anywhere but up after 2022, right? But does this then kind of extend, given that we also see a strengthening yuan? Does that anchor some of the more positive forecasts that we see for other emerging markets?
So first and foremost, yes, we do like the China story. We do think the news that's come out has been fast and furious, much faster than we had anticipated, anybody in the market had anticipated, frankly, as it related to COVID, but still a bit cautious, as I was saying earlier, for Q1. We do think, much like we saw the trade play out with ASEAN in terms of a bounce back, COVID reopening, I think that story is going to play out in China, and that should have good effect for all emerging markets. I think the thing that is a bit more cautious on broader EM, one is the fact that the markets that have actually benefited from reopening or have commodity premium, Indonesia, India, are expensive. So I think that's one concern we have with EM. The second concern we have is that if indeed the slowdown is occurring in DM economies, US, Europe, well, one of the casualties of that is going to be EM, which does produce and sell into those markets. Plus the weakening we've seen in oil prices are both reasons for somewhat more caution with emerging markets. So more of a wait and see with regards to EM as we look out, and more of a wait and see with China, at least through till Q1 plays out.